All right, the equities still are in kind of stuck in a neutral mode. We were like in fifth gear last week after the election, and we've really stalled this week. I'm going to break down this week's moves, including today, in areas of the market that we kind of thought would benefit from strength in yields and strength in the dollar and strength, from a new administration. That particular area of the market not necessarily doing so well. So I'm going to break that down in today's video and how the kind of what we're seeing in these 3 days and how likely we are to get more of some weakness. Again, not necessarily like bear markets or corrections, but probably a little bit more weakness than you would have expected, considering that we just had this kind of parabolic run. We're especially getting a parabolic run in the dollar, which is kind of rarely positively correlated with stocks. And we're also getting a relatively parabolic move in yields as well. That's also been positively correlated with stocks here recently. So those haven't been normal correlations, and we'll kind of break down what we expect now to see because of that. Because of this big pop we had on the Russell, there are some indications suggesting where the Russell may go here in the next so many days. We'll break that down, whether or not we've seen a high already in the Russell 2000 or not. We'll take a look at the sector rotation, very interesting patterns there, especially related to yields. And then we'll take a look at our trade idea, which is actually in the healthcare sector, but it's breaking, the stock itself is breaking down not just in a pullback mode, but is actually now potentially entering correction mode. See, all stocks can be doing something different. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, November the 13th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join us at MarketScholars.com for free, right up there. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're following us on our blog, check out some of these other things over here on the right, including a Market Outlook live video. Come down to the bottom. Click on this heart, or you can click on this link right here. It takes you to today's tweet. Hit that like button there. Same thing here. Click this thumbs up icon. It takes you to this page. Scroll down to today's Market Outlook post. Click on that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. You can see our Market Outlook live sale is live for the rest of the month. Through the end of the month here. There's the link with our coupon code to get the 20% off of our subscription. Sorry there, let me put this up here, our subscription. And you can also get to that page by clicking on this orange button at the top of our website. Also displays our Black Friday sale there. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we were slightly higher today by a whopping point, a very small range, well below the average. Remember, the average is actually is lower now, below that 1% mark on a normalized basis, right? 1% being, again, 59 or almost 60. The intermediate line is above the 90th percentile. It's pulled lower, but still very strong bullish levels. Market sentiment lines rising, still very strong bullish levels. So the trend is still intact, right? We're getting a short-term decline as we expected. We've been talking about this last 2 days. The near-term line is dropping as we thought it would, right? It's very strong move higher. Not surprising that we lose some momentum. The momentum line's higher because, again, the range actually is bigger than it was these few days where it was just in the 30s. And we were slightly higher today, but again, even the momentum line is not necessarily back up to bullish levels. It's just not in bearish levels right now. It's both lines are in neutral territory here. We are still easily above the 2.5% mark, above the moving average, so still at bullish levels pretty easily. The NASDAQ 100, as you can see, was down a little bit today. It's third small down day in a row, but nothing too significant. Both the intermediate lines still strongly bullish levels. Market sentiment lines not as high as it is on the S&P, but still pretty darn high. And the near-term lines in the lower half of the chart, but not in bearish territory yet. So, not necessarily that we haven't seen the extent of the near-term decline, but probably have seen most of it, right? This is probably, it's not going to go down very much more on this current decline. And again, unless it really turns bearish, which is unlikely to do because the momentum line didn't really get down to extreme levels. So, doesn't mean it can't, because things can change on a dime. But just off of current what things are currently doing. That's not the same for the Dow. You can see the Dow, the near-term line is at bearish levels. It's not below the 20th percentile. The momentum line did get down to extremes. So this is, the trend's still strongly bullish on a long-term basis and intermediate basis. In fact, we did get an intermediate decline, very, very small one. In fact, I don't even know if it got to a 5% tag on here. No, it didn't even get to a 5% tag. It ultimately got to, did it even get to a 4% tag? Let's see if it got to 4. Nope. So 3%, 3.5% decline is all it got to. So it didn't even get a full 5% decline here. That kind of goes to show just how really weak. But it was, according to the market forecast, it was an intermediate decline because your intermediate line did get down in the bearish territory. In fact, it almost got in the reversal zone. And you did get dark pink shading and a red line, albeit for only 2 days. But, I mean, that's the definition of an intermediate decline there. So this would technically be the beginnings of a new one. But, again, absent a decent reset. Now, we didn't get very much of a decline there in August. Intermediate line got down to about the same levels, a little bit longer. And then it turned up higher and started a new run. So, there's the potential that could happen, but we also didn't start with such a drop in the momentum line, not until we got that bull tag. So that's a little bit of a concern there, as well as the near-term line falling as far as it has. So you can see it didn't fall this far at all, except for, again, that one period where we got the bull tag. So that would be a little suggestive of the fact that we might go down a little bit more on the Dow Jones, considering how bullish it was. That's probably not a surprise. The Russell 2000, you can see, also had another down day, almost a full percent. Its momentum line avoided getting to extreme levels yesterday. It came close, but it did get down there today, and the near-term line did drop down. So after a strong bullish near-term rally, this is a bearish near-term decline. So now, granted, this is hardly like you look at like from a Fibonacci retracement level. We're just barely breaking the 23% line of the last near-term rally. So this is hardly that significant of a drop on an actual price basis. We're still well above the moving average, over almost 5%. But again, a little bit of a sign of concern there that we might get a little bit more of a decline than we may be comfortable with, right? We saw that over here. We stayed sideways for a little bit longer, but we saw that over here when you got, after the big move higher, you got such a big drop initially off of that peak that it didn't necessarily go down immediately, but at least it set the peak, and that's kind of what we've been talking about here. We might have set the peak. We've been talking about this for the last week or so. We might have set the peak on the Russell, and this is kind of a sign on the market outlook that we may have set that peak there. Let's take a look at the weekly chart for the S&P 500 now. And you see again how strong the bullishness is, how high we are on the PPO. So everything very, very bullish from that perspective. That's great. Obviously 3 green arrows across the board, even on the Dow and the Russell, but you can see we are losing momentum. So even though I heard on TV today that the S&P still has momentum to the upside. No, it doesn't. Just because it went up today doesn't mean it has momentum to the upside. It's losing momentum according to the MACD histogram there. But that doesn't mean it's going down. Just because it's losing momentum doesn't mean it's going down. Right? It's still going up, obviously, just not going up at the same pace. Hence, losing momentum. We're still easily above moving averages. We're still way above the 17-day moving average. Even the Dow and the Russell, which remember have been a little bit more bearish here, they're still easily above the moving averages. So any kind of weakness we're getting is simply just a move back down to those short-term moving averages, and really nothing more than that. You see that as well in like the DMI indicator. You can see the DMI is still strongly bullish, right? Well above 30, below 20 on the negative indicator. Now looking at some of these others on the Dow, see how strongly bullish it is. And then the Russell, which is a bit more weaker, it's still, it's very strongly bullish there. It's not as, parabolic as it's been, but you can see how, again, it's still bullish despite the weakness of the last couple of days. The RSI and the CCI are still at pretty decent levels. They're on the S&P 500, and then on the Russell again, despite the drop from parabolic moves, they're still at pretty bullish levels, with the RSI still being above 60 at the very least. Looking at the Ichimoku cloud, S&P has got a weak trend. Still doesn't have the intermediate strength trend, which we talked about probably won't get because it's kind of hard to when you've had a mature trend that ended and then we didn't get a reset to be able to start a new bullish mature trend. IWM did get a mature trend, right? We got above 80, we got above 5. But again, when it goes up from 0 to mature trend in a matter of a few days, it's hard to sustain that, as we've talked about before. And you can see it's already starting to lose a little bit of that strength there. It's better to be able to maintain it. You need to kind of build into it. And that hasn't been the case. It wasn't the case in July. And so far, it hasn't been the case here right now either. Finally, looking at the Bollinger Bands on the S&P 500, again, we're still in the upper quartile. Not as strong. It's not as strong. The bandwidth is rising. It's still not even like the halfway point of the 150-day range, but it's still rising. You're still bullish. Still got bullish momentum. The bands are still outside. You're still above the Keltner channel, so that's all fine and dandy from that regard. IWM is a little different. We're not in the upper quartile anymore. The bandwidth is a lot more extreme. We're below the upper band, and now we're below the upper Keltner channel. I told you those are the two steps to reversing a parabolic move: is getting above the upper, or getting below the upper band first when you're so extreme, like we were, and then getting below the upper Keltner channel. So with the Bollinger bandwidth as high as it is, momentum as high as it is, we may be peaking in that momentum according to these charts. Finally, let's take a look at the intraday charts. You can see we did not get a new high, so your rune indicator is still kind of just moving lower. Got a long ways to go until that red line gets to 0, which means that this gets all the way over here. So it's still got a long ways to go there. That's on the S&P 500. IWM, remember, that was our bigger concern because of the vacuum, and it looks like we're getting, again, a lower high and a lower low, closing below yesterday's low. It looks like we're getting sucked into that vacuum, which we do not need to fill in any of this gap. We want that to stay some kind of breakaway type gap. And the S&P, we're still doing okay, even though there's a vacuum here too. But it's still okay. We're not threatening that gap like we are in IWM. But we can we can have more of a near-term decline than we might be comfortable with because, there's still other gaps to fill and a vacuum there as well to fill in. Obviously, today's range and volume were both lower than average numbers, a little bit above average in the volume, but below average on the range, which is fine because we want the range to be lower. We want it to be below 1%. If it starts to go higher again, that's the concern. Volume is picking up, so that's a little bit of a concern too. Increasing volume typically is not associated with bullishness, and we're not really dropping very low. So that's something to kind of keep an eye on the S&P over the next couple of days. If we happen to get bigger than average down days here, it might kind of suggest that we might not be out of the woods. Volatility showed a very interesting pattern. Big drop all the way down to the 85% mark, which this year has been the extreme low. Typically 80% is the extreme, but 85% has been the extreme all year long. And we just dropped down there out of nowhere today, dropping easily below 15 for the first time, going all the way to 14. So that's great. Typically that means that your VVIX is also dropping below 90, and it did not do that today. In fact, it actually rose and is back up above, like it's been above 90. It was at it's been a little bit below 90, 88.6, 87. Then we got back up the last couple of days, 89.45 yesterday, and now it's back up. So on a day today where it dropped considerably, the VIX dropped, it would have been nice to see the VVIX drop below 90, and it did. So the 90 is this line right here, and it didn't, right? It actually jumped up, and as I mentioned, got up above 90. So let's see, let me take off this, because that's kind of confusing. So you can see it got to 90, and then now it's moving higher, and that's not typically the VIX and the VVIX have a very strong positive correlation. So if whenever there's been a jump in the VVIX, a lot of times it is there's a drop in that correlation that precedes it. And this is only one day, but it's such a significant day. It makes me wonder if why we dropped so much in the VIX to extreme lows, at least for this year, for this calendar year. On the VVIX, on the VIX itself, this level is not so low, but remember, relative to the VIX 3M, and we are at low levels. Remember, we are below the 200-day moving average as well. So the VVIX should have dropped below 2. That's at least the corresponding levels it had at these points where we failed to get below 15, and we didn't. And that's a little bit of a concern going into the rest of this week. As to in terms of, again, are we going to just go higher? Are we going to have a 5-day winning streak or a 7-day winning streak from today going forward? Most likely it means, at the very least, that this near-term decline that we're on right now is probably not over for the next at least couple of days. All right, now let's take a look at what's driving this price action. You can see the 3-month returns there, but if you look at the last couple of days, really the last 3 days, here, let's go to custom, and we'll go to this week, right? This week that we've had so far after such a great week last week. This has not been the greatest week especially for like the small cap index, but it has been an outstanding week for the dollar. Tremendous move to the upside. Russell was great initially on that dollar move. It hasn't been great since. Gold is down 4%. Emerging market, international stocks just in general getting hammered by that strong dollar. Bond yields are going up considerably as well, as TLT is down almost 3%. And you can see finally IWM started off strong against the Qs, have really reversed that course. The Qs are still flat. They haven't really moved one way or the other. But IWM went from a pretty decent gain early to now a pretty decent loss relative to the Qs. You can see that on this chart here when we take a look at the ratio chart of the Qs relative to IWM. It had dropped so much below that 200-day moving average, and you can see the rebound that it's had the last couple of days back up at least to the 17-day. Remember that there's typically a positive correlation here, so if it gets above these averages, that's actually a good sign for the markets. We'll come back to that breadth discussion here in just a second. But it's really that dollar and the move in the dollar and the move in yields that are really dominating the markets right now. Look at the dollar index, one of its biggest 6-day moves it's had since the election that it's ever had. We looked at the rate of change on that in our class today. Look at that move, tremendous move to the upside. When in a market where we've already been bullish, right? We've seen this before where you're establishing a trend and then you just get this like big outsized move. And that was kind of our topic for today's class, was kind of like recognizing that you tend to get parabolic type moves towards the ends of already established intermediate trends. And you see that, this is a relatively parabolic type move for the dollar index. I've mentioned how big that move has been, and we've already been established on one, and look how far lower the negative indicator has gotten, way lower than any other instance except for like over here again. And then look at the ADX, well up above 40 at its highest level for a positive move that we've seen in the past year. And you have to go back quite a while to see a positive ADX this high on a positive move. You have to go back to 2018 when we really started that move here. So, and we're heading into some highs that we've seen here relatively recently. Again, on a parabolic run, how much longer can that type of run last, right? And you can see a very similar type of move we're seeing in the 10-year yield as well. That's as you just saw, is in a convergence pattern. So it's been bullish here for a while. Let's see here. There we go. You can see again, its ADX was up above 40. The positive index is up above 40. The negative index is not so bad, so that's why your ADX is high. It's above 30, but it's not extremely high. But still, it doesn't get extremely high unless things are just going haywire, like we're getting a rate hike cycle, right? Typically leads to parabolic moves in yields. We're in a rate cutting cycle, so for us to get a relatively parabolic move in yields and a rate cutting cycle, especially when you are as correlated, lately at least, with the 10-year yield with the stock market, right? You can see it's been positively correlated here lately, which is typically true of an inflationary environment. Even the dollar has been positively correlated lately with the S&P, and that's not typically true. And typically when you have correlations that aren't normal, they tend to precede corrections, right? Whether it's a pullback in equities, whether it's a pullback in the dollar, some type of corrective move, and we'll see how that impacts the S&P 500, because this has been again a very irregular type move when you look at those two together. Let's take a look at let's look at the breadth of this move that we're getting. And remember, yesterday our oscillator turned negative, and you can see it's still negative today. It's actually even more negative than it was yesterday. We also talked about the money flow not really supporting this big spike that we had, and you can kind of see that, like with the money flow itself looks great, but the money flow index, barely getting above 60, obviously not getting to extreme levels there. Let's look at those charts here over here, and look at the number of stocks that are producing new highs and new lows. You can see the new highs index. That says it's at 24. The average right around 176. It's really at 192. The new lows is right on the cusp. 72 is the magic number. So that is right on the cusp of getting a Hindenburg omen, like right on the cusp of having all three. Remember, we got those 5 in a row right there. So the new lows is getting, remember, it's up to 70 now, so that's the highest mark. It was 69 there on Halloween, so this would be just by one stock the highest level we've seen, as we're starting to ramp up. The average is moving up, like that's, you can see the skew. We've already talked about how long that this has been at extreme highs, up, dropped to 140. This is yesterday, it dropped to 140. And then today, it's still right around the 140 at 141. Remember, dropping below the average is actually bearish. We want to be above a rising average on the skew, not below. But the average is so extreme, above 150, that it's hard to get up above it. And so now, again, we're back below. The number of stocks above the 50-day moving average is, right around its average there, back to a lower number. The number of stocks above the 200-day has been below, which again is not bullish. Like, this is a sign that breadth is deteriorating with this index getting it back above its average and it's rising. It's typically bearish when we see that. We don't want to see it rising. That if the markets do stay bullish as it did, it's because we have shifted from a broadening trade to a Magnificent 7 trade where that leads the way higher. And that has been, if you look at just this week alone on that sector comparison, and then we'll go again back to November. Remember, the dollar's been so strong, yields have been so strong. If you look at this past three days on the sector rotation, real estate utilities are interest rate sensitive areas, so they will struggle and with higher rates. But look at technology. That's the sector we want to lead the way higher, and it's not necessarily leading. It's still above its averages, so it's not hardly like tanking here. But you can see both the relative strength and the momentum. We're still not at levels we want to see. It's in the lagging category. It's over here in the red on the lagging on a daily basis. We want, XLY and XLC are looking great, but not XLK. And that's the one that needs to be that's our leader. That's where Apple, Microsoft, and all the chip stocks, and that's what's driving this AI trade. It's a reflection of the AI trade, and it's not showing relative strength. And considering how overweighted it is in the S&P relative to probably its historical average, we need it to be the leader, and you can see it's not. In fact, the leaders this week had been two of the others, XLY, XLC. That's great. Financials, kind of interesting because that's the other cyclical, industrials, financials. Energy has been leading, and again, that's not a sector that we want to lead the market. Energy. If you look at when energy typically leads, you can see XLK's ratio with SPY is positively correlated to the S&P 500. XLE's ratio with SPY is negatively correlated. So when it outperforms, like it has been doing, that's not typically a good sign for the S&P 500. And you can see it has been underperforming during this bullishness for a good chunk of time, but now is starting to outperform. And you can see we're getting into the leading category on XLE. And that's, in my opinion, a sign, not necessarily the greatest sign for a protracted run that's already mature. And I've been talking to you about this before. We're already mature in this run that we've currently had, getting up to almost 16%. But it means that we are likely to get a red tag here probably by the end of the year, which is not a bad thing, right? And probably will only be in the 5% range. And that's okay, right? Because again, if you get that, then we can get another green tag in early part of next year which I expect will happen, but that will be in the teens again, if not into the 20s. That would be great, right? Considering, a good first half return. And that would be a reflection, in my opinion, of the FOMC deciding after December's meeting, which they're widely expected to raise cut rates in December. I expect that to get to 100%. I do expect a cut, but I don't expect a cut anymore in January or into this first half of this year, which would be a reflection of a good bullish market in the S&P in the first half of next year. All right, and that takes us to our trade idea of the day, actually in the healthcare sector. As you can see here, let's pull up Viking Therapeutics has had a big down day today, down almost 9%. You can see the stock is down the last few days, so it's not just today. They've got dark pink shading and a red line coming off of a bearish near-term peak here. Obviously, the intermediate line is below market sentiment. It's in bearish territory. In fact, we're almost at a cluster level. Extreme lows on the momentum line typically happens when you're in bearish trends. You have the first of a week of a bearish period here, the red line. In fact, this is one of the bigger candles that you'll see on a week that you actually do get the red arrow. Typically, you can see in some of these other instances, you got a big candle, but it was after you've been bearish for a few weeks. So the same thing here. You had a pretty decent sized bearish candle right there, but again after the red arrow, and the same thing here the week after the red arrow. So we're getting that on the week of the cross below the 10-week moving average. Kind of suggests that we might just be beginning a bearish move here, especially when you got 3 red arrows on the stock with an increase with the red line and an increase in volume on that bearishness. MACD and stochastics, you can see clearly bearish, especially when you look at their 2-line versions here, clearly bearish. This is the big key. We broke the 200-day moving average, so we are now into the correction levels, right? A pullback gets you to the 200-day moving average. Breaking the 200-day now puts you at correction levels territory. So that's not necessarily the best sign. When you look at some of these other oscillators, you can see they're also showing breakout moves on them. You're almost above 30 on the negative indicator, below 20 down there on the positive indicator. The ADX is still below 20, so in a trend-ready state, so to speak. When you look at the RSI and the CCI, you can see that they're also below 40 for the first time here in a while, below minus 100, well below minus 150. If you look at the weekly, it's almost below the minus 100 level, which also is signifying potentially the beginning of a trend. I also failed to mention this gap that we have over here that we've been filling in from back over here in February. We're starting to fill in that gap towards the bottom, which would be down to that 37.5 level. Look at the Ichimoku cloud. You can see another breakout move today because we broke below the cloud for the first time. Negative rate of change. Intermediate strength trend almost. So we don't even have a mature bearish trend yet at all. We're just kind of getting started on this. The first day that's actually there is a trend according to those indicators. And then finally, if you look at the Bollinger Bands and the Keltner channels, we are up against that lower band, right up against it, not below it, but right up against it. The bandwidth is starting to rise up to potentially its 150-day high point and potentially beyond, as we are also down against the lower Keltner channel. The bands themselves are moving outside the lower Keltner channel. So you can see how bearish we're starting to get on the stock. So maybe just starting to get. So what I decided to do here was say, okay, let's take a look at the low 20 delta. We'll come out to December expiration, sell that low 20 delta, buy a strike away. That puts us here at about a 2-to-1 reward to risk ratio in position size. You can see the stock is already slightly working in our favor since we got into this. I remember I put this on before the market close here. In fact, I'm recording this right now, right after the Market Outlook Live that we've done for all of our premium subscribers. So there's our trade idea for today. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody. We'll see you all tomorrow.